Good morning, traders. Welcome to FreeFX. My name is Francesco Sani, and today in our new beginner series, I'm going to discuss a topic that's been suggested by forum user Eddie B from babypips.com. Today is the 28th of April. We had quite a lot of events in the last 24 to 48 hours. And indeed, it's worth keeping them in mind as we go forward. And they are the Federal Reserve Bank rate decision, the Reserve Bank of New Zealand rate decision, and the Bank of Japan rate decision. So we're going to start a discussion with the standard disclaimer. And just remember that anything that I use is really for myself. I'm a retail trader. Although I'm not a professional trader, I trade from home. And the products that I use are really just based on trial and error. So the broker that I use is FXCM. It's not a product placement, it's just who I use. So if you have any questions about that, great. But it's really just because I use their trading station or market scope charts. So all the charts you'll see are based on their kind of setup. But the topic for today, which again has been suggested by forum user Eddie, is the following: reading charts. And I've put this question, which is this an art or a science? So I'll try to explain what I mean by that by going straight into our first chart. Okay. Now, some of you are beginners, so this video is hopefully useful for you. And if you're not a beginner, maybe you'll find this interesting anyway. But so I really try to cater for people who may have come into trading recently or have done demo, but are not sure about what they are supposed to be doing in terms of going live. So how to make sure that they have the right skills and so on. So our previous video, number 1, in the beginner series was a video about trying to assess what is the best way to get into trading by using a trading plan. So how to make a trading plan. This is about how to read charts. So you've got a trading plan, and let's say that you worked out that you want to try trading short term. And we mentioned tick charts as well on the previous video. I don't really use tick charts, so I'll go as far down as 1 minute charts, which is what we have in front of us here. And this is the New Zealand dollar, NZD, and USD, US dollar. So this pair is one of the majors and is a so-called commodity dollar, called commodity major, or ComDoll if you want to use the abbreviation. Now, you can see at the moment on the right-hand side of the screen that the candles, the last 4 candles, are red. Okay, so let's say that you've decided from your trading plan that you have the time, or you want to try being a scalper, which is somebody who, and there's a lot of debate about what a scalper actually is, but generally speaking, a scalper would be somebody who goes into a lot of trades during a trading session, which could be a day or half a day, and they take a lot of trades for small gains or small losses, but small gains being something in the region of 5 to 10 pips maximum. And so I'm sort of generalizing here, but that's sort of to give you an idea of what a scalper is, and their positions might last anything between a few seconds to a few minutes, but certainly they would be looking at charts like tick charts or 1 minute charts, or so to a scalper, the 1 minute chart would be what their bread and butter. Okay, I don't scalp, so I don't have any quick tricks to show you. But let's talk about reading charts. So we start with a 1 minute chart. Okay, we have a lot of candles here. There are different ways to set up a chart. So the candlestick charts, there's a whole science of reading candlestick charts, and these were introduced a while back from the East. They were measured in terms of how they were used. They were used to measure rice, and in Japan, in ancient times, the different types of candles give you different bits of information. So they've become very popular because they have a very compressed very easy to understand graphic component that gives you all the information. So to take these last few red candles, for example, we have the solid candle in this case indicates that the open and close price are the same as the low and high, except this little bit sticking out here at the bottom indicates that the low is not the same as the close. So the close is where the solid body ends and the low is just a little bit below it. This is even more evident in this candle here, this blue candle, and you'll find some charts have green instead of blue. In fact, usually green candles are bullish candles and red are bearish. FXCM as a default has blue as bullish rather than green. Okay, but you can see that the reds are still red, so that sort of makes it easy. The wick here, the wick is the long thin stick that you see at the bottom of this chart. So the wick here is quite long. In fact, it's about the same length as the solid body. And this means that price opened up here, okay, and then it pulled all the way up and closed at this point here. And at some point, it pushed low to as low as this, but then retreated all the way back. So the wick is like a trail in the water, okay, and the solid body is the ship. Okay, so this is where the ship stops, but this is the trail that it left behind. So when you see something like this, going back a little bit, see this very long candle. This is known as a doji, and there are a lot of different names for different types of candles. But one that I use to describe indecision, or this type of candle really generally, is a doji. So this one is a doji, this one here is a doji, and all the way forward here, this is a doji as well. A doji is a candle where buyers and sellers are basically indecisive. So you will see that the body is very compressed, almost non-existent, and there's a very long wick. Okay. So there are different names for these. Some of them are called dragonflies, etc. So, but basically, what it says is that price moves all the way in one direction, all the way in the other direction, retreats both ways into some very, very small open and close space. So the open and close are very, very tight together, and the rest is just movement up and down. So the wicks are all that's left. And sometimes these are read as reversal signals, and sometimes they're not. We'll get into that in a moment. So let's go in order. First of all, this is a candlestick chart, but there are different ways you can set up your chart. So on here, for example, on MarketScope and FXCM, if you go to chart mode, you'll see there are different options. You have line, bar, candlestick, and table. Okay, the table is this, just price in numbers. And if you wanted to go into reading charts, you wouldn't want to use this. This is for people who want to trade, quote unquote, the professional way, or quote unquote the old-fashioned way, or whatever you want to call it. I don't want to offend anybody, but it's certainly quite different from chart reading, and I'm not too familiar with it, but some people swear by it as being the way that professionals trade. They don't try to read patterns, they just look at price. If price is lower than the previous day on the open, or they might look at the high and trade the difference in the high. If the high is higher, then price is trending up, and they enter a buy position, and so on. This kind of depends on how you operate. If you prefer reading charts just to have a quicker view, a sort of eagle eye view of the markets, then that would be what you want to do. So there's the candlestick chart that we've seen. Now look at the bar chart. This is very similar to the candlestick in that the bar tells you all the information that you need. Okay, so if you want to look at this, for example, you'll see that the open is the hook up, the stick on the left, okay, and the close is the stick on the right. And then the bar itself essentially is the low and high. Okay, so in this case, for example, the low, this candle, is lower than the close, but the high and the open match. Okay, so if the stick goes forward, so that's the doji that I was indicating before. You can see that it's very obvious. So if I show you that in the candlestick form, you see that's a doji. So the price obviously went all the way down and then retreated up. And you see it in the other format, the bar format. You see the open and close are very, very tight together. And this is the low. Okay. So there are different ways, but some people use bar charts, some people use candlesticks, and you find niches of people swearing by one or the other. It really depends on what you're used to sometimes. The line chart has different bits of information. And in this case, you have 3 bits of information. Some people like to use just the close. Okay, so if you use the close line, then you just see the closing price of your chart. So, for example, here this would be the low, and here this would be your I think, yes, so we have 3 lines here, and if you go into here, you have options to take off some of the lines. So if I take off the red, that's the low line gone, and the high, that's gone. So what you've got left here is the closing price. So the closing price is basically what you have on the line chart overall. Now this is a very good way to see things. Candlesticks, overall, if you compress candlesticks over a long period, like this, okay, you still see the shape. But when you're looking at a closer period, it is a little bit more jagged. So if you're wanting a purer sort of chart, the line is the best for that, because it's more linear for that reason. And if you're overlaying different bits of chart, for example, if I did something like, I won't explain this just now, but if you did something like this, so this is the Euro USD being superimposed. Now you've got 2 bits of line. Obviously you can make them different colors. So if I just tick on that, if I can. Okay. Okay, try this one perhaps. Make that a different color, and so here we go. So now the Kiwi dollar is at the bottom, and the Euro US dollar is in green. Okay, so with lines, it's a little bit easier to see things clearly. So you might want to use that for that reason. Okay, let's take this off and return to what we were saying a minute earlier. So we have these different types of price charts. We've got different types, and I'm going to return to the candlesticks. That's what I use. Now, at the moment, we're looking at the Kiwi US dollar, and just as we started the conversation, if you remember, we had 4 candles here, and the 4 candles were showing red. So at that point here, I was looking at possibly a sell. If you're a scalper at this point, you look at where we were and you think sell, and you would have got in, say, at the start, the opening of this candle here at 0.6960, and maybe aiming to have 10 pips, and this low is 57, so it's 3 pips. You would have waited 3 minutes, 1, 2, 3, and you got down to 56, and that's 4 pips. And if you waited a bit longer, you would have missed your target of 10 pips, because it never got to 50. It's opened at 60, and it got as low as here at 55. It's sort of 5 pips. And now the candle we're looking at forming right now is trying to push lower. So then you'd have been in your position 1, 2, 3, 4, 5, 6, 7, 10, 11 minutes so far. Now that could be quite a long time for a scalper, and you'd be quite anxious to get out of the trade at this point, because this could very quickly reverse. Because when it comes to short-term charts, it's very difficult to assess the direction of the market. You're in and out constantly in both directions, and it's constant chop. You get in here going long, for example, because you've got a long candle, meaning bullish. You get in here, and then it starts going low, then high, then higher, then low, then high, then low. Then it's pretty much level, stuck between these two pips, 66 and 67, and then it goes lower and then higher and then higher. By this point, you'd have waited 25 minutes and you started getting quite nervous. That's a very long time for a scalper. So you can't get emotional as a scalper. As somebody was saying the other day on a trading video, there's no place for emotions as a scalper. You will get emotional, and it's very high tension and high energy. So it's very counterproductive to be trying to trade in that environment and getting emotional. It will be devastating, just mentally, but also functionally, but also for your account. You'll start taking losses, trying to push a trade longer to get your target. So if you get 3 pips, you aim for 10, you get 3 within the first 2-3 minutes. That's the trade done. Close. And if your spread is 1 pip, you gain 2 pips. That's great. Bearing in mind that when you're trading these small amounts, you wouldn't be trading 1k, 1000 currency units. You might be getting a position of 100,000. So 3 pips on 100,000 in euro US dollar would be basically 30, okay, $30 or 30 euros. So that means that you don't need to push for 50 pips, because that would be 500, but then equally you would lose 500 if it went the wrong way. So your stops would be very tight, and for a reason, because you have a bigger leverage. You're leveraging up, trying to excuse me a moment, I need to interrupt this. Okay, so I was saying that we have this situation where trading with a bigger leverage means trying to reduce the risk of high losses. So you'd be aiming for very small movement, and your stop would be quite tight. Because again, if you are trading, say, 100,000 currency units, whether it's 100,000 euros, pounds, dollars, yens, one move in the euro US dollar would be 10. So if you lost 10 pips, that would be 100. If you lost 50, that would be 500. Okay, and if you're doing lots of these trades every day, say 30 trades, 40, 50 trades like this a day, it adds up. So it's better to take a small loss of, say, 2 pips, which is 20 currency units, than to take one of 200, because you then have to think about all your following trades, and it affects you mentally because you're trying to make up lost money all the time. Whereas if you make a small loss, you're in and out quickly, you know you're going to make that back, and then you assess at the end of the day your profit and loss, or P and L, and you see how much you've made overall. So it's a game of odds, of seeing overall how many, if you have a winning strategy over many trades. So this is the short-term approach, and this is reading a chart. Now, within that, I've come to the second point, which is having an idea of how a chart is going. So for the scalper, this 1 minute chart is all they might like to see, but they might like to know that their trade has the best probability. So if you take a short here, this was our fourth candle we were looking at earlier. So if you came in at 69.60, 0.6960, and you knew that there was a major resistance, or sorry, support, or demand zone, if you want to call it that, then you might have wanted to stay away and just watch to see what's happening. So even scalpers may know the wider picture to know that their trade that they're about to enter in has the highest potential. So then you go up to the next. Okay, so we're going up from the very smallest to a higher, and then a higher still. This is the 5 minute. Now you see that already there is further back something we may have missed had we just stuck to the 1 minute chart in the window that we had on. You see already that we're going back a little bit further to the 28th, which is today, but going up to the start of the morning almost. So this is going back to 9:30, and around this time, so about nearly 3 hours ago, we had this sort of zone where price seems to hold, and you see this long wick, which means that price tried to push lower and retreated back up, and then it pushed higher and higher, and now we're sort of slumping back down. But you know that this is coming up because we're very close to this, which is 69.45, 46, and we are only 7 pips away from that. So if you knew that and you were scalping, you might sort of wait until price tested this area again. If you bounce back up, you get in long and try to get, and this is the next level up, which is up to 69.71. And again, this 69.70 or 71 was a resistance. So at the moment, we have an area between here and here. This is where you start looking at the wider picture, and in order not to miss things, because you might forget, you might want to add your own levels, and this is where it comes in very handy. Now you can do a line that's limited in length, say from here to here, that's all you need, and then one here, okay, and then extend it a little bit further. Or you might want to draw a horizontal line that expands throughout the chart. For example, take in the horizontal line and just have it on here, more or less. So this extends beyond the limits of this window to the right and left. And so if we expanded that all the way, say, to a weekly chart, you see that line still holds. Keep that in mind if we want to look back to our 15 minutes. Let's go up to 30 minutes. Now, these are the levels that we drew, limited to this area. So this is the area that we were looking at, the limits of this line. Now, with the 30 minutes, we're going back quite a bit. Okay, we're going back into yesterday and the day before, so about 2 days as a window. And you see that the levels that we're at are quite extreme compared to where we were here, because we were down here all the way to 68.25. Now we're around this 69.54, because what happened yesterday or last night was the Reserve Bank of New Zealand rate decision, which pushed price higher and higher. So you can see how, relative to where we are, we push quite high, and price is quite supportive of this level. Okay, but again, these levels of support can be extended, and you see that previously, when the Reserve Bank of New Zealand said they were holding rates last night, price pushed up, and then there was resistance, and it got stuck. And then you see another level of resistance, which you wouldn't have seen on the 15-minute chart, and that is here. Let's put a horizontal line, because this will come in handy. This is what's known as a round number level, 0.6900, or 00. These levels are meant to be significant. Some people say more in stocks than in Forex. Some people say they're significant in all asset classes. And that's really depending on how it goes. But I would say, keep an eye on them anyway, because, sometimes smaller prices, if you're trading something like the 1 minute chart, let's go back to the 1 minute chart, you don't really see all those big numbers because you're trading between those big levels, say between 69 and 70 in this case. They're quite far apart, and you've got 100 pips to play with. And if you're playing with 10 pip gains, that's essentially 10 trades in a row. So there are lots of in-between levels, which might be something like 69.55, or you might get numbers like 69.66, and then you get very precise. However, as you move up, let's go to the 30-minute chart again. As you move up, these little numbers tend to make less sense. You might go more for the approach of the round number lines, like 0.6900, and then the next one up would be maybe the quarter number. There's a whole video on YouTube by someone who has made a system called the quarter, I think it's called the quarter system or something like that, which again utilizes these quarters based on the 100 pip gap between levels. So the 25 would be, in that kind of system, a very significant number. And indeed, 0.6925 here creates quite a bit of resistance, and then when it breaks through, that's your opportunity in that kind of strategy to trade up. The next level up then in that strategy would be the 69.50, because it's the halfway between two double zeros, between 69 and 70 in this case. And then the next level up would be 70. Okay, that's 70 there. So the halfway would be here, and indeed you could say by coincidence or not by coincidence, the price is interacting more directly with this halfway price between 69.70, the 69.50. And indeed it's trading heavily against this level. So it's squashing here for 30 minutes, 1 hour, 2 hours, is compressing very small candles against this price. And if you go further back, you see how at this point this price provided a resistance or supply zone for sellers to come down here. Now if you look at here, you'd say, well, this is 68.22. It's not a round number figure, but if you look down to this level here, 68. Now this is where reading charts is an art more than a science, because when you start as a new trader or as a beginner retail trader, and you're teaching yourself, you've looked at different sources, you've checked the Baby Pips school, you've checked Investopedia, you've checked trading books, you've looked at educational videos like this. You obviously want to see clear-cut notions. You want to be taught exactly how things work in the markets. You want to be told that when you see A on a chart, it means C. When you see B, it means D. In other words, clear answers that fit a learner that needs very sort of simplified notions to just get on with starting trading. However, it's worth remembering, even at that point, that as you go to slightly higher time frames, you start seeing things that don't quite fit with that. For example, here you see that this is pretty much on the money, right on this level at 0.69. So the theory holds here that we have a support at this point for that, or you want to call it a demand for buying, and here you've got resistance or a supply, which is selling. Okay, now you've got these two contrasting interactions that price has with the same level, which is 0.69. Before, it was providing a barrier to price going higher, and then this happened, the rate decision came in, price broke through, and once it broke through, it didn't have enough strength to go further back down. It stayed above it, and this means that we're looking at a wider picture approach, and also that we're less concerned with whether price is exactly on 69 or slightly above it or slightly below it. For example, if we look at this low wick, it reached 0.6807. That's 7 pips away from 0.68 down here. Now, if you're trading, as I said, 1 minute, 5 minute charts, that can make all the difference between a successful trade and a loss. 5 pips. If you're leveraging up to 100,000, a contract of 100,000, you have gained or lost $50, €50, whatever you're trading in. So this, you have to be quite precise. And if you've seen this candle before, you know that this is a very precise resistance level. So you take this in a 1 minute, 5 minute trading scenario and raise it up to here, and then maybe adjusted it to here, because that would be maybe where resistance had gone to more recently. So if you're trading then going forward, you want the more recent levels. But if you're trading on a wider time frame, you might want to stick to the round numbers, because there is something called an elastic band approach, which is very much trying to see these as elastic zones where you have so just the contrast, I'm going to remove this. I'm going to use a rectangle. So I'm going to use a rectangle. So let's say our zone went from the low of these two candles, okay, so these two candles here, and the wick entered this area, and this wick entered this area. And then we're going to extend it by using the ruler here. we have from here to the round number level, it's 23 pips. So from here, 23 pips down would be down to 67.75. So I'm going to extend this to 67.75 right there. Okay. So now what we have, and I'll put the horizontal line again to show you what I mean, is we have the okay. So make this a little bit thicker, and we have a scenario where you're looking at something a little bit more flexible. So your line here will be something like a precise point. So the precise level here is 68. Okay, let's give it the exact number. And the zone is 23 pips either side. So that when price enters this zone, even if it doesn't test the 68 level, you know that it's bound to go back up. And then if we encounter that after, you'd have this as an example of how price interacts or interacted with this round number figure. It may not actually test it, like here, where it's really heavily compressed against it, really touching with the body of the candles. And here as well, with the wicks and the bodies, we're very close to it. Here we're not so close, but it's still testing that general area of 68. Again, the wider you go with your time frames, the less you are looking for precise or pip perfect, as I call them, entries. So this really depends on your trading style. So at the moment, we're trying to say, what kind of trader are you? If you're a scalper, you can go up or down. And maybe at this point, if you're a scalper, you're looking at the 30-minute chart, and that's all you need to know. The price has basically gone up throughout the morning, and it's testing this level around 69.50, and so it might push up higher. So maybe you want to get in on the next candle. You want to get in and trade a bull move. But only for a few pips. So you might trade a bear move for a few pips. So you're not too concerned with the trend. You want to know roughly where the levels might be, just a little bit higher and lower generally. But you do want to know what happened 3 months ago, because that is the realm of the day trader. So the day trader trades intraday moves, and they do need to know the general levels going further back, for example. So a day trader might look at a day chart. This is the day chart. And you see the levels that we drew before, the 69 there and the 68. And that was the interaction that we had in very recent history. So let's take that interaction out, just because it looks odd. But let's keep those levels there. That's a 70 up there. That's a 69. And that's a 68. Now, if you go further back with the day chart, you can go back to weeks and months before. So this is going back to beginning of April, end of March. And then to the left of the chart, you see the beginning of March, the second week. Now you see that the 68 area has been very strong support here on the 5th of April and on the 6th of April. In this time, you see that price is compressing and then tries to break through. Now to a scalper, that move down to 67.70 would have been 30 pips, which is 300 if you're doing a trade with a high leverage. So that's quite a big gain or loss, depending if you're on the right side of the market or not. Well, hopefully you wouldn't have had a 30 pip stop. You would have had a maybe 3 or 5 or 8 pip stop at the most. But anyway, this is to say that if you're looking at these as wider areas, you wouldn't consider this necessarily a break, because in the next candle it fails to reach above it and it closes below it. But then if you waited another day on the 11th, so after the weekend, you'd have seen the price went straight back up and even broke through 69. And then 4 days later it broke through again, and this time it pushed higher to 70.50, and then it retreated in a 3-day straight fall, 20th, 21st and 22nd, and it gave up 200 pips in 3 days. Okay, so what took essentially many days to achieve. It gave up in just 3 days. Now, if we look at the daily chart, you will notice, unless you have a sight impairment, you will notice, and I'm not being funny, but if you didn't notice this, it would be quite rare, because you can see something here, that this high is or is it not lower than this high, which is or is not lower than this high, which is or is not lower than this high. So if we try to really highlight these points, you'd see that they are gaining height as we go. So from this perspective, you start seeing things in a different way. So no longer do you have one answer. Where before, when we were looking at the 1 minute chart, we were seeing right at the start of the video, we had 4 red candles, and the 4 red candles were showing you a bear wave. Okay, so from a scalper or 1 minute perspective, you are seeing a sell opportunity. Okay, you're not even calling it a trend, it's a sell opportunity. As you see things from a wider perspective, you start looking at general movements through time, and that's what we call trends. And this is really where you see the possibility of riding something, a move, for a longer period. Now, that just could be a day, or it could be a week, or 2-3 days. So let's try to do just that, to draw something that sort of joins these dots together. Okay. Now, this is where it's an art rather than a science. You will notice that there's no doubt that this is riding higher. And indeed, if I took this line and put it at the bottom, you will see that from this point here, the low of this candle on the 16th of March, so the low of this candle today on the 28th of April, you have gained height. Okay, we've gone higher. We've gone from 66 low to a low of just above 68. That's 200 pips gain from the bottom of this trend low to the bottom here of this trend low. Okay, so let's take this line and put it back up to the top. Now, you will see that we've confirmed that the lows get higher and the highs get higher, and that's a confirmation of an uptrend. An uptrend will carry on as long as the market wants it to carry on. There's no guarantee that it will continue forever, and one of the rules that people prescribe to is that if you touch a trend line, if you like, 3 times, 2 or 3 times. 3 times is the golden touch, twice is the minimum. So let's say that this trend could be extended to here, that you started seeing a higher high, which is not really, but let's say that this is the start of the trend, because it's the second time the price pushes higher. So 1, 2 touches. At this point, you know that there is a trend, possibly, and you might have wanted to maybe draw both lines and make them as parallel as you can. Okay, and maybe do this. We'll come back to how straight lines should be and all the rest in a second. So at this point, if you got in here, you would have had a drawdown of about 130 pips, 140 pips, and then it would have pushed higher. So then you would have been in profit by 69, 70, 140 pips. So maybe you could have exited here. That could have been your profit target, 140 pips. Conversely, if you had entered closer to the bottom of this trend line, depending on where you draw it, you could draw it here. Okay. In which case you could say we've broken that bottom of the trend line, or you could draw it here. Okay. There are different ways to draw these trend lines. We'll come to those in a minute. But let's say that you saw that even without an actual trend line, you saw that price sort of started rising again, and you entered about 68. So this round number level had been surpassed, it had been broken past it. This candle started at 68. You enter around 68, say 68.10, just for confirmation. And then you kept this trade on all the way to past 70, at which point you started getting nervous and you thought, oh, this is going to reverse. You would have gained 200 pips. Okay. Now, obviously, you might have leveraged a little bit lower, because that's quite a large move for somebody holding a 100,000 currency units position. So you would have probably held something like 1,000. With 1,000, a 200 move on Euro USD, for example, that would get you 20. If you'd open a 10,000 currency units position, a 200 pip move on Euro USD would have been 200 currency units. With Kiwi US dollar, it's slightly different, but we won't get into that just yet. We're looking at charts at the moment and reading charts. One of the things you have to understand is that what I mean by art is that if we were scientific about this, there's nothing scientific about this line. It's all over the place. Why? Well, because it should be touching either the wick top or the candle top, and it isn't clearly doing the same, because here is touching roughly both. Here is not touching either the candle top, that is the close or the open, or the wick or the high. Here it's not touching the bodies of the candles, but it's actually cutting through the wicks. And here it's touching the body and then the wick. So if you were to be precise about this, you'd have to either draw different trend lines with one major trend line and then some kind of sub trend lines. So let's say, for example, that you wanted to only enter when price retreated from the high. So basically the wick of the candle in these cases. So here's the wick number 1. Let's start here, for example. Now here it's cutting through, so maybe you want to get it to the wick, but then your line goes out of kilter with everything else. So maybe you want to take the second wick. Okay, at this point, say you start the trade, so you extend it back from here and try to get the right angle to join with this wick. Okay, now this wick and this wick both touch the line, and so you're happy with that. And this one didn't make the top wick, so then you might say, well, if I took a scientific exact approach, I would say that we've missed. Okay, it was a miss. But price retreated nonetheless. So then you have to make a decision. Do I trust my strategy that only when the wick or the high touches the trend line, do I trust to go short? Like in this case, go short and you gain your profit. In this case, you don't go short and you miss out on your profit. So if you're trading this in both directions, high, then sell, then buy, then sell and high, and so on, you would have missed a signal here. So then you have to decide, okay, maybe I want to make this a little bit more interesting, and I'm going to be a little bit more subtle. I'm going to add a second line. This one only joins the tops of the candles, that is, the bodies. So in this case, I'm trying to get all the bodies to touch. So in this case, you see that the different candles are essentially joined at the candle tops. So we're joining the bodies. Now, we have two candles, and things start getting a little bit interesting. So we're going to give them different colors, and we're going to give this different thickness as well. And so this candle is joining the wicks of the 4th of March, and then it's skipping these candle tops, and it's going to the highs here on the 30th and almost touching the 31st of March wick. So we have these interactions. Okay, these ones essentially. One interaction, then one here. This circle also represents the second line interacting with the body of the candle, and then interacting with the body of these two candles. And then this line cuts through the middle of these two candles' bodies. So this is where it gets a little bit tricky, because you have now two lines essentially missing a few points. Okay, this line here is missing the tops of these candle bodies, and it's cutting through the bodies of these two candles. So it only really works for the start, but then we don't know it's a trend by then. So we're drawing this retrospectively. So only by this point we start seeing a trend going up. Okay, this line here joins the tops of the third peak wicks, and the wick of the very first, the start of this trend top. So really, these lines are not satisfactory to me because although they are precise in what they do, they're missing out the point, which is to roughly, and this is where it comes into an art rather than a science, you're trying to get a general pattern. It doesn't have to be precise, it doesn't have to be right to the last pip, it doesn't have to join everything neatly. You're trying to see a general pattern. If you don't want to draw your own lines, what you might like to do is to get some indicators. And indeed, one of the forum users, again, Eddie, had suggested maybe popular indicators might be a topic of one of my videos. So we'll try to dedicate a video on this beginner series to indicators separately. But just to say that one of the indicators you might like to use is something called a moving average, which takes the average of price over a certain number of days or periods, and it gives you an average line. And by following the interaction of price with that line, whether price continues to be below that line or above that line, you have the equivalent of a sort of trend line, essentially evidencing that. So you don't have to draw it yourself. The algorithms, the program draws it for you, and probably more precisely so. But it's also a little bit more flexible because it's a line that undulates rather than being a straight line. Other things like Bollinger Bands, you would have heard of these, invented by somebody called Bollinger, and the Bollinger Bands are essentially elastic, and they follow the contours of the highs and the lows of price, and so they give you a sense visually of the shape of a trend. One thing you can use as well is something called Andrew's equidistant channel. This is available on this particular software, the FXCM Market Scope, and you can do it freehand or not. So you draw one line, then you draw the next line, and it's equidistant. So you know that the lines are not squint, they are actually exactly parallel. So if I did this, for example, okay, these two lines are equidistant. So we know that the distance between the top line that I've drawn and the bottom one is always the same throughout this distance. You can also extend these. So if you want to continue this, you can extend it this way, and you can extend it that way. Okay. And now you can see that actually this trend really truly started way back here in January. Okay, and you can see the interaction of price. Now at this point, it seems that there's almost like a subline there. So you might want to say, okay, if I load it there, but then you only have one interaction at the bottom, and you have several at the top. So sometimes drawing two lines, or a channel as it's known, is appealing, and sometimes it's not. In this case, if you put it here, for example, we start with a low here in January, first interaction, second interaction, third interaction, fourth interaction, fifth and sixth. We have 6 interactions in a span of 3 months. And that's a good compromise between putting it close to the tops and close to the bottoms where you have a lot of gaps. So you're getting a good balance of interaction visually between tops and bottoms. Okay. So perhaps you take the middle section as your guide, make sure that it touches top and the bottom of the middle section, and then the extremities take care of themselves. So that's really why we start looking at trends. But now that we've established that this is an uptrend and this is a daily chart, let's go to something like a weekly chart. So let's see how the Kiwi dollar looks on a weekly chart. Now we see these levels that we drew earlier, 68, 69, and 70. They're starting to compress, aren't they? They're starting to compress more and more, so that eventually they'll become so compressed that you won't really see them as wide levels, but quite narrow levels. And you might want to go into bigger gaps between levels of 200, 500 pips between them. Now, this is the uptrend that we were looking at. And how does it fit into the wider picture? So this is going back to the end of January. If we go back to, say, this is April, May of last year. So today is the 28th. So the week starting the 30th of May of 2015, which is only a couple of days away. How were we positioned with the Kiwi US dollar? Well, the close of that candle for that week was 0.7042. The high of this week so far is 0.6988. So we are almost coming full circle from 69.88, nearly 70, and this was 0.7036 on the close, which is nearly 70. So we've almost come. So this is almost like a swinging level. You know, it swung all the way around it and back to it. And if we went further back, what then? Well, then we see that we've come from these highs and we bounced back and we are starting to climb again. So we have two approaches at this point. One, the short to medium term, going a few hours and days, and then that gives us an uptrend. No doubt, this is an uptrend, okay? This here is an uptrend. And if we go further back to September 2015, we see that essentially we bounced back, and this looked like a double top, continuing lower, but then it corrected itself and it's actually creeping up. So if you were to say that such a long devaluation of the Kiwi dollar led to a bottoming out, this would be a good buying opportunity. If you believed and had proof from price that indeed it was moving away from this bottom and it wasn't just a correction leading to a continuation to the downside. Now we're looking at something much wider. This is suitable, as I said in my previous video, for people who position accordingly with very low exposure, say 1,000 currency units, and taking a trade into several weeks perhaps, and even months, or possibly years. And indeed, had you traded the Kiwi dollar all the way back, and let's go to the monthly chart for that, to as you can see here on this chart, if you've gone back all the way to 2001, 15 years ago, May 2001, we were down at 0.40, believe it or not. And then we went all the way up to 0.73 in 2005. And you can see actually that the price at 0.69 and 70, where we are at the moment, has actually been an interaction, a quite strong interaction, and a supply level for this very large uptrend of 3 years, from 2001 to 2004, almost 3 years to the month. Price went up and up and up, and then it stopped and stalled around this area, dropped down, broke through, dropped down, and finally broke through permanently, leading up to the 2008 great financial crisis, and then it bombed out to 0.50. And then it started climbing again, and then there was interaction here again, but this time, unlike here, it didn't have so much resistance, and it broke through quite easily. And then it led to an even higher peak, to almost 0.90 or 88. And then it sort of struggled through, tried to break higher, and then slumped again. So it slumped in August of last year, when we had the great Chinese debacle, or market crash, and there was that big drop. And then it bottomed out again, and it started climbing. So, to put it in other words, our little trend here, which if you're a scalper is enormous, but it goes from January to now, so 3 months. This 3-month uptrend, and you can see that if you look at the monthly candles, this represents January, and it's a bullish candle, although the price had actually retreated, and you get a long wick, retreated all the way from the top. So a very small candle, but the next month it opened where this candle closed, this 65.88 roughly, and then it pushed higher and higher and higher, and that was March. April, we've got a very sort of indecisive candle, a lot of wick at the bottom and the top, which tells us that there may be some indecision into continuing this trend. We've not made too much progress above this 69, which was resistance back here in October of last year, and it was resistance back here in December of last year. And we've not made huge progress, but we closed above it, potentially. We're nearly at the end of the month now. So, just to say that this is an uptrend, 3 months in a row of bullish candles, blue, blue, and blue. If you look at the bigger picture, this is a very large downtrend, and this represents some kind of wide range, if you like, and or wedge narrowing, both ends. Then you see that this is an uptrend and this is a downtrend, and this could be the start of an uptrend again. How would you see that? Well, let's try what we said before and add a trend line. So if I added a trend line like that, now I'm going to make it a bit thicker because it's a larger period and I want to be just a little bit clearer with my markings. So I'm going to make it quite obvious, okay? So over a large period, and we're not being pip precise here, roughly between 0.40 to 0.90, okay, that's 5,000 pips. We have this trend line. Now I know that the purists among traders would say, well, on a monthly chart, this piercing of this trend line is massive because this trend line at this point is around 0.5250, and the bottom here is 50, so that's 250 pips. So it's not a small break by any account, but certainly if you weren't holding any position at this point, you're just watching this, you could have traded it back as it came up here. It wasn't really a break. It was a short enough break to wait a couple of months and get in and ride this all the way up, possibly, or at least to halfway. So you can see that this is a trend. We have a start of a trend, but it really doesn't confirm until here. So this is basically the first wave and the second wave. And now it's confirming with the second touch of this trend line bottom and starting to pull up again. So if you were trading a day chart on an uptrend, you could confirm with something like the monthly chart or the weekly chart and see the bigger picture and say, okay, definitely this is a good place to get in because I can trade this for a few days and then maybe let it retreat a little bit like it did here and then get back in, etc. Now remember, these are monthly charts, so if you're looking at from here to here, that's basically a year more or less. Okay, that's 2009 February, and that's February 2010 there. So just between here and here, you could take profit within the first year or 10 months, and then it would consolidate for a few more months, and then it wouldn't be until January of 2000 or end of 2010 where it started actually pulling up again for the next wave. So here, because of the huge scale, the sheer size of this trend, you might want to draw a secondary or intra trend line and make this a different color, say red or pink, and make it a little bit thicker like that. Now you've got a secondary trend line which shows you further interaction with this particular set of levels. Okay. So then you could say, well, I want to trade the range between this resistance, support, and this resistance here, and that gives you, from 60 point something or 60, 0.60 to 0.80. That's 2,000 pips. That's a pretty good move. Okay, and then you could say, well, I want to go from here to here, and this time it broke through. So if you're short, even better, carry on and help yourself. Maybe use a trailing stop and ride it all the way to the next level down. And so now I hear you say, well, this is very easy. It's all good and well saying this after the fact. It's very easy to spot trend lines. True, absolutely true. Spotting something like this forming and riding it from the very first pip all the way is nearly impossible. You can get caught out. It could be a false bounce. It could continue down. In this case, it was a false break, and it just retreated and continued. So at this point, we have to decide if what kind of scale we want to trade and how we want to read this chart. You could also say that this chart is indeed showing an uptrend, but you can take it even further and say that this level of interaction with this level here, as you can see from previous occasions, shows that it's a very strong level, and the candle this month is showing a lot of indecision. Okay, and this may be a sign that price is not ready to bounce back up, and maybe the dollar is going to appreciate more. So there are possibilities that this may not actually follow through. So just because a trend line fits a graph like this doesn't mean to say that it guarantees anything. Because it could well not work out. It could be a false move and then it continues to the downside, in which case we'd have to reevaluate, hopefully not by losing all our money and blowing our accounts, but hopefully being still able to trade. We could say, well, maybe actually what I'm seeing here is I'm not so interested in this huge 15-year move. I want to look at more recent price action and ignore all that. And then you can go back to your dailies and say, okay, I'm redrawing these. Now what I'm looking at is a long-term wedge. Okay, I'm still looking at a long-term period, but not as an uptrend, as a wedge. And then you can sort of go into slightly less price action and say, it's a wedge, and this wedge is going to break to the downside. Why? Because there is strong resistance here. Okay, it broke through and it didn't manage to bounce back up, and I see resistance at this level, so it's not going to break back through this. There isn't the motivation, and etc., etc. So then what you might like to do is to look at another chart to compare things a little bit and say, okay, what is the US dollar doing? So you take the US dollar and you add it to this chart, like so. Take the US dollar and add it to this chart. You see the line, okay? Now that's the blue line of the dollar. Obviously it's inversely correlated, so it's a mirror version of this because this is a Kiwi dollar, US dollar. So the dollar is on the opposite side. So if you are looking at the US dollar chart versus the Kiwi US dollar, it will be a mirror version. And you can see how the dollar is behaving. Okay, so how is the dollar positioned? Well, it's come off from these highs, and it's come down all the way to here. It's bounced back, and it's riding higher. So you could say, oh well, but if we reverse things a little bit, took this trend line and turn it upside down, now you're looking at the blue line, which is the dollar line. And to make it more visible, I'm going to change the color of that into black. See the black and make it thicker as well. That's the dollar now. Now you can see that this top and this top show that the dollar is bouncing off a long-term trend line and riding lower from there. However, there's another way to view the dollar, which is the fundamental way, which is that the dollar is appreciating because of the Federal Reserve Bank wanting to raise rates. And we had that Federal Reserve Bank decision yesterday, and it didn't really raise rates. In fact, it said not at the moment, but will do so later in the year. And the markets didn't really move on that because they do believe that they will do that later, but maybe in June. And that's a long way away. So at the moment, the dollar is not really moving. It's not depreciating, it's not appreciating, it's just staying there. So that gives indecision to things like the Kiwi US dollar, which is why the monthly candle for this month is that sort of doji, wicks either side, not much of a body. Okay, so from that point of view, we could also say, well, let's look at more recent past. So I'm going to limit myself to say the last 5 years. Okay, so we're going to from 2001, make that a little bit wider. 2001 to 2016. That's all I'm going to see. And if you looked at that, you could say, well, okay, going to delete that trend line and going to draw a new one. So for the last 5 years, the dollar has been appreciating, and in fact, it's gone up all the way. So this is just remember, it's a line chart for the dollar, so just the close, just showing you the close. And so from this sort of bottom here, we have bounced back, gone up. Okay, is it going to come down to here and test it again and go higher? Possibly. Or we could draw this in a slightly different way and say, well, actually, what it was this. This was the trend, and it broke through this trend line slightly, but then recuperated. Now we come to the bottom already, so it's going to go up from this point, not from this point, but from this point. And that means that the Kiwi US dollar is ready to actually go lower, if that's the case. Which means that we should see, if we made this into a line chart, for example, okay, and said, oh, make it a bit thicker as well, Can't make it thicker, can we? No. Okay. So let's say that we wanted to have a trend line there. Now that's not quite a trend line. That's a top there. Okay, that's almost a straight top. So we have a top here around 90 or just under 90, 88. And that's been tested twice in 5 years, 2011, 2014, so 3 years. And it's sort of tumbled down from there. Let's get rid of that line as well. I'm going to clean this now. So when you are reading charts and you're reading them in different ways, clean up everything that was before, so you can see things a little bit more clear. That was our trend line for the QE dollar. I'm going to take that off as well, and we take off this as well. Take that off, take that off. Now we have a clean chart with lines. So here's the top line. It's this kind of resistance or supply for the QE dollar over 3 years, more or less. And this is the rising trend line for the US dollar. And essentially, what we're seeing is that the QE dollar has depreciated. And just at the bottom here, you see that 0.70 was a support, but now it could be the new resistance. And this could mean a spell lower. We came from 0.40, remember, and we can well go back to that. There's no reason why not. And the dollar has come from a long way. And if you look back, the dollar has come from these levels. Okay, so it's made up about 2/3 of that rise, but there's still room to appreciate. So again, seeing things into perspective sometimes can help to reevaluate what you're actually seeing, and also taking both sides of a currency pair, looking at the movement of something like the dollar as an index by itself, as opposed to just paired up to another currency, makes you appreciate how that particular index is performing and what influence that might have on a major like the Kiwi US dollar. Now, I know that some beginners start with the Euro US dollar. I apologize if I chose this, which may seem like a strange pair to do a whole video with, but I trade the Kiwi quite a bit, so I find that I'm more familiar with it. So I have a few theories about its tendencies both up and down. So for that reason, I chose this one. But it's a major nonetheless, and some of you might trade it. So I thought this would be a useful one to trade, especially given that the recent event risk we had yesterday, as I showed you earlier in the video, that huge candle, and that was due to not so much a technical move, but to the fundamental move from a central bank holding a rate unchanged. So that's a fundamental view that we haven't got time for in this video. I hope you enjoyed the video. Thank you very much for watching, and I will see you in the next beginner series videos, and this will be on probably the use of indicators on charts. So thank you very much for watching, and please leave your comments and like, and I look forward to seeing you in my next FreeFX video. Take care and happy trading.